Damien, I think you're muted.
Sorry about that. You'd think I'd have this whole working remote thing figured out by now, but I guess not. So let's try it again. Hello and welcome to Simply Tax. Speaking of working remotely right now, on the podcast today, we'll be getting an update on the latest in the state and local tax world, which, like the federal world, and I guess pretty much every aspect of the world in general, has been altered by responses to and the impact of the SARS-CoV-2 virus and the incidence of COVID-19. With many like myself working from home or conferencing from the kitchen table as a result of telecommuting and work from home arrangements, there are a lot of challenging questions that are swirling these days from a state and local tax perspective. So, I called up returning guest Mary Reiser, along with colleague Jana Gradeva, to cut through the static to help us better understand the complex and seemingly ever and rapid changing SALT world. Let's kick things off with the seemingly simple, yet surprisingly complicated topic of telecommuting. There have been a number of proposals and calls for legislative action to resolve conflicts and streamline income tax reporting requirements in light of the large amount of teleworking that's going on right now. But as of today, Wednesday, August 26, 2020, we have yet to see legislation advance. But before we get to some of the complications that the current situation has perhaps magnified, perhaps the best place to start is with the question of how state and local tax jurisdictions generally apportion a taxpayer's employment income. Mary, could you help us out with this one?
That is a really great question, Damien, because you are right. We've all been working from home for what feels like forever now, I think 4 months or so. And right now, for some of us, there's a lot of uncertainty about when we will actually go back to the office and get working from our normal work locations. So there's a lot of telecommuting going on. And usually, when we're looking at how to source an employee's compensation and wages, you're looking at where is that person actually performing the service, where are they actually located when they're performing the service, and you're sourcing it to the state where they're actually performing that particular service. But in cases now, there are employees that maybe were working in one state and now are working from a home office or a temporary location in another state. So the question comes up as to, for employer withholding purposes, does that employee get withheld in the state where they're working now? Do they get withheld in the state where they should be working, if you want to say it that way, their actual work site location? And that's come up really recently a lot more, I think, as the stay at home arrangements, the work from home arrangements have been extended, and there's a lot of uncertainty about when we'll go back. I will point out that, there are states that have what we call reciprocal agreements, where two states basically agree that if there are residents working in the other state, that they will each withhold or allow withholding in the state of residence for those employees, as opposed to in the state where they're working, just to make life a little bit easier for the employer, a little bit easier for the employee. And if you happen to be working in a state that has that reciprocal agreement now as a resident working from a home office, then it's sort of a no harm, no foul situation. Nothing's really changed for you. They were withholding from you for you at your state of residence before, and now that's become your place of work, and they're withholding for you there now. So, that's the really simple arrangement that obviously would be convenient. There are some states that are called, well, we like to call them complete convenience of the employer states. These are states, and there are a handful of them: Connecticut, Delaware, New York, Nebraska, that come to mind off the top of my head, where they've had a rule that unless someone is working in a state for the convenience essentially of the employer, for that employer's business, purposefully, then even if they're working in the other state, it's still considered the employer's state, the employer's work site, essentially, that state is considered the state where the withholding should be done. So I gave the example of New York. If someone is working for a New York company, but they're working from home in New Jersey, and it's not because that New York company actually wants them in New Jersey doing something with customers per se, or performing services there per se, then the withholding would be done in New York, regardless of the fact that the person was actually working from New Jersey. So that's kind of an interesting arrangement that's obviously a little bit the opposite, I'll say, of your reciprocal agreement. So there are a couple of different types of arrangements in states already that you'll want to kind of look at and consider. But, right now, the $1 million question, so to speak, is if I am working in, say, for example, Nebraska, but my normal work site is in Colorado, does that mean that my employer should be withholding for me in Nebraska now versus Colorado, or not? And what I would say is there are only really a handful of states that have come out and provided some sort of guidance to say that because of the pandemic, that there will be a waiver, I'll say, of sort of the nexus and the sourcing of that compensation to the state where the person resides as opposed to their work site. So there is some uncertainty right now as to how that would be treated. It's very nice that there are states that have come out and said, "Hey, we're not going to say that you have created nexus in the state, or that you have to do withholding just because an employee is working in our state. We're going to kind of consider this to be business as usual, so to speak, in terms of how we apply the rules." But even for those states that have kind of gone out of their way and have made that sort of announcements, I think there's still uncertainty about at what point that ends. I mean, a pandemic doesn't exactly have a milestone timeline associated with it. We can't all look into the future and stare into our crystal ball and think, oh, okay, well, November 1st of 2020 is going to be the end of the pandemic. So, on that date, then this arrangement ends. So there becomes kind of a question as to, well, ultimately, even with the states that right now are kind of offering up this waiver, what is the end of the pandemic? Is it the end of official stay at home orders, or is it a longer period of time, depending on, the state that you would typically work in, or the state you're residing in? And will states be kinder in terms of how they're going to interpret the beginning and end of the pandemic when they're looking at this in, say, a year or two, when they're doing audits and things like that? Or is it a situation where they're going to take a more narrow approach? And if it's, the end of the stay at home order is on May 18th of 2020, then that is when they consider sort of your time clock to be up in terms of your ability to work remotely. So there's a lot of uncertainty just around even that question for states that have provided that relief. When is the end of the pandemic?
I feel like we are just always saying like the it depends thing, but I mean it really just highlights again that even the end is not straightforward. So how it's been responded to, where you are, even obviously the state of in the jurisdiction, but also where you are in terms of how the virus is progressing and what it means for you. So it's a tricky one for sure.
Yeah, it's funny that you say that. I often think that a state and local tax podcast, it could be as short as, you just asking me a question and me saying, it depends. And then we just stop.
I think that could just be the name
That
of the
would really
podcast,
sum it
Mary.
up, wouldn't it?
Yeah.
Yeah, you know what? That I should start my own state and local tax podcast called It Depends.
That's too funny.
Anyway, getting back on track here in terms of the telecommuting. One interesting question that we've thought about as well is, okay, what if you are working in one state that takes one approach, but then you are residing in a state that takes a different approach? So, for example, if Colorado says, "Hey, we are going to waive nexus for employees. We're going to tell you that compensation while you are working during the pandemic is wherever you would typically be working, keep withholding in that state. But in the example I gave earlier, Nebraska takes the opposite approach. There sort of becomes a question of credit for taxes paid in your home state as well. So if that withholding now is being done in Colorado pursuant to sort of Colorado's rules, and you go to file a tax return in Nebraska, is Nebraska going to allow you to take a credit for taxes paid for your Colorado withholding? Or are they going to say, well, that wasn't really our approach to the pandemic, and we think those wages are Nebraska wages and that should be sourced to Nebraska? Now all of a sudden you have this really unique situation of double sourced income. My hope is that the answer to that question is no, and that that's not going to happen and we won't see anything like that. But you really just never know. These are kind of the topical conceptual questions that come to mind when we're thinking about, what are the issues surrounding the pandemic. And then of course, just beyond the whole concept of, okay, what is, the employee sourcing of compensation? Where do you have to do the withholding? Things like that. There's also the question, Damien, typically I would tell you that a telecommuting employee of a business would create nexus in a state where that telecommuting employee is working. I'm going to say, I'm going to use a broad stroke term here and say generally the case, but I'm going to caveat that by saying, please talk to your tax advisor about your specific facts and circumstances. But, we would generally say that that's the case, and that there is a little bit of case law in some states, and certainly some states that have had rulings, private letter rulings and things like that would indicate that telecommuting creates nexus in that particular state. So, beyond even the employee employer withholding implications, there's the question of, okay, well, if a state doesn't take a position that there's a waiver, or if they decide that, the waiver is only during the stay at home orders, and Mary Reiser and Jana Gradeva are still working from home after the stay at home orders ends. And there's still a question also of, on the business side of things, okay, do, we create nexus for the companies we work for? And are there going to be income tax implications at a corporate level or a pass through level, things like that. So in that situation, if we're looking at sourcing and apportionment for a company, how does me performing a service in a certain state impact, whether revenue is considered sourced to that state or not considered sourced to that state? Do my wages go in the payroll factor of the state that I'm working in as a resident, or do they go in the payroll factor of the state that would be my work state? There are just, a number of different implications. We're all really worried right now about sort of the employee employer side and withholding, but thinking a little bit further down the line as well, there's the implication to the business itself in terms of the nexus that might be created by having telecommuting employees.
Jana, anything that you would maybe add from the sales and use tax perspective? I mean, obviously, we're talking about kind of the income tax side of things, and taxing income and income tax apportionment nexus. But what perspective would you add, I guess?
I mean, from a sales tax perspective, I'm going to mirror what Mary was saying in general. Having an employee telecommuting or working from their home usually creates nexus. Now, the states have not issued guidance or anything specific in terms of, this kind of temporary situation with stay-at-home orders and how that changes things. So we're gonna generally see how that unveils in maybe the next few months or maybe even later. But usually that's kind of the rule, a basic rule for physical presence nexus is having an employee that is working or residing and working in the state. And usually when we say residing, is the assumption is that many employees will work from home. So this kind of covers our telecommuting here.
And, Damien, also, I would add to that, the funny thing is we're talking about the here and now, right? And employees that are working from home right now. But you have to think that this pandemic is going to cause, I personally think, a little bit of a universal change in how we work, and that we're going to see just generally more employees working from home, even past the point of maybe a vaccine, or when the pandemic starts to slow per se. I think that something that's come out of this pandemic is the idea that, hey, you know what, you actually can work fairly remotely, that you can do it fairly productively, that in some ways it actually has been beneficial to people because now we're home with our families more. We're not having to go through the 45-minute to hour commute that we make into the offices that we have been doing. So there have been some, health and sort of family type benefits that have come out of this. And I think that long term, we'll see more employees probably working from home. So, again, staring into that crystal ball out into the future, you have to ask yourself, could this type of situation actually instigate maybe some legislation down the line that would address this, because we are going to see more of it? Would there maybe be some federal or some state legislation in states to specifically address telecommuting employees and in a more, black and white fashion, so to speak, than what we see today?
Speaking of other ways that we've seen responses to the COVID-19 situation, is obviously legislative and federal legislation, namely with the CARES Act, I think probably being the biggest, at least so far. So I guess with the enactment of that legislation, we saw a lot of different changes, some of them to the tax reform items that we had a couple years ago. But what are some of the consequences at the state and local level to those changes?
That's a really good question, Damien. And I'm sure that anybody who has ever heard me talk about state and local tax is going to say, I get sick of hearing Mary Reiser talk about Internal Revenue Code conformity. But that is really what drives the answer to the question of how are the states impacted by the CARES Act, for example. I've said this before, there are generally three types of conformity. There's, rolling conformity, there is static conformity, and then there are states that don't really adopt the specific IRC, and they kind of have their own little provisions of it that they adopt. So I say there's really kind of three different types of conformity: specific, reference, static, and rolling. And you really have to look at which of those types of conformity applies in your particular state first. If it's a rolling conformity state, that essentially means that as the Internal Revenue Code changes, so does that state. It basically conforms to the current Internal Revenue Code, and that's then you always know kind of where things are at, so to speak. It's whatever the most recent IRC is, at least as a starting point. If it's a static conformity state, it means that they adopt the Internal Revenue Code as of a specific date and time. So maybe it's as of January 1st of 2007, or as of January 1st of 2015. And then you have to look to, okay, well, what was the Internal Revenue Code as of that particular date? And those are the rules, how the state basically adopts federal taxable income, and certain aspects of the tax calculation of federal taxable income, and modifies itself, is based on that. And then of course those specific references, those look to, specific pieces of the Internal Revenue Code. In that case, you have to understand what that specific conformity is. It's probably the hardest one to kind of wrap your head around, truly. So obviously, if it's a rolling conformity state, you look at the CARES Act and you say, okay, well, on its face, it's going to adopt the CARES Act. And then what you have to look for is, is the state going to do something legislatively then to modify that conformity? Because we're all used to, for example, bonus depreciation. That's probably the easiest example for me to give for businesses. And that states don't always conform to bonus depreciation. It's providing an accelerated deduction at the federal level. The state doesn't really want to give up the tax revenue associated with that accelerated deduction. And so they will deconform to that specific item and have a modification written into their statutes for that specific item. So in much the same way, with the CARES Act, we'll be looking to see in both the rolling conformity and the static conformity states whether at some future point in time they may make some legislative changes to actually modify the conformity that they have related to obviously the Internal Revenue Code related to pieces of the CARES Act. I'm going to use probably what I think is maybe the easiest thing to get my mind wrapped around, qualified improvement property as an example. The CARES Act sort of retroactively changed the life of qualified improvement property to be 15 years now instead of 39 years. So when you're looking at that, I think a lot of people from just kind of the early conversations that I had always think of the conformity being a matter of, oh, well, do they follow bonus? Do they not follow bonus? And not really specifically thinking about even sort of the lives of the different assets. And with, the QIP fix is what I'll call it. Now we've both changed the life of the asset, and by changing the life, obviously, we made it possible and allowable to take bonus depreciation, qualifying for bonus depreciation. So you'll look at, for estate purposes, if you're in a rolling conformity state and they adopt the bonus depreciation, meaning that basically they don't have a modification that deconforms from it, then that, hey, for qualified improvement property, the state actually does allow the 15-year life and it does allow the bonus depreciation. Now, if you are in a static conformity state or looking at a static conformity state and their conformity date is before the CARES Act, then what you have is, okay, they don't follow, first of all, they don't actually follow the change in the life of the qualified improvement property. So you don't have 15-year property and it doesn't really qualify for bonus depreciation. Now you have a difference that is a little bit more than just bonus depreciation between your state depreciation, which is now going to be based on a 39-year life with no, bonus depreciation, and federal depreciation, where you have a 15-year life and you get bonus depreciation. And I think people are so used to thinking about, bonus, non bonus, and that kind of deconformity, but I don't think people are used to thinking about, well, is the life of the asset actually different for state purposes than it is for federal purposes. So I think that's something that will be kind of difficult and interesting for people to look at and get their minds wrapped around. Shifting just a little bit even beyond the question of, that particular the life and the adoption of bonus, you have a couple different options in terms of making that change for federal purposes. You can go back and amend returns. You can do a 3115 with the current return in order to do an accounting method change. And when you're looking at the state side of things, even that adds some considerations. It's, what happens? Do I need to do state amended returns if I do a federal amended return? And then there's the question, if you don't do the amended returns, you don't do federal amended returns. Instead, you go ahead and you do the 3115 for the accounting method change. Does, the state actually adopt the accounting method change? Do I need to do something separate if it's even allowed? Do I have to do a separate accounting method change relative to the federal accounting method change? Are there, forms maybe that I need to include with my state return to show that accounting method change? So there are some different things to consider in terms of not only just like the conformity, but then no matter which direction you walk down from a federal standpoint, is there just some consequence on the state side in terms of either disclosure or amended returns that you need to be thinking about as well? And some of the same questions come up, Damien, obviously, when you're thinking about net operating losses. I like to use depreciation because I think we're so, used to it. We understand it. We can wrap our minds around it. We know, we always make adjustments for bonus. But obviously, for net operating losses or the 163J, we have to look back to the conformity and ask all of these same types of questions. What is the state's conformity? Most states have their own separate net operating loss provisions. And so you might not actually even have a carryback that would be allowed in a particular state that might even be a rolling conformity state otherwise. They might have a special modification for net operating losses, and they don't allow a carryback for purposes of the state. So you have to look at those types of things for net operating losses. You have to consider the conformity when you're talking about the 163J changes, things like that. So the conformity, even though I think everybody gets sick of hearing me talk about IRC conformity, really drives what the implications are from a state perspective.
Maybe it's actually kind of a good point of transition because we've crossed the 2-year mark or anniversary of whatever you want to call it of the Wayfair decision, and all that kind of came from that. And we've obviously talked about that. Mary, you've been on and talked about it in a number of episodes. But I guess in light of all this, I'm sure that kind of adds even a little bit more pressure, I'll say, on the state and local jurisdictions because of the fact that there has been a lot of disruption, and I know that's impacted a lot of the revenues to the states. So, given the fact that we're a little more than 2 years in now after the Wayfair decision, and also maybe this added pressure from the COVID situation, what should people be focusing on right now, and what are some of the latest developments related to the Wayfair decision?
This is definitely kind of a good time to talk about it. There have been a lot of developments. So the whole Wayfair case is not a stagnant case that sort of happened 2 years ago and then everything else became clear. What ended up happening over the last 2 years is almost all the states, with the exception of 2 or 3, jumped on the bandwagon, and now they have some type of economic nexus standard. Most of the states still stick to that $100,000 or 200 transactions, but they do vary.
As a quick aside, please check out episodes 28, 57, and 58 for more on the U.S. Supreme Court ruling in South Dakota versus Wayfair Inc., which significantly changed the landscape of Nexus for state and local tax purposes about 2 years ago. As we discuss in the episodes, and we'll hear more from Mary shortly, the Wayfair decision has also had some crossover effects to income and franchise taxes as well. Let's hear more from Jana on how things have changed.
What we have seen in the last 2 years, that states started changing their thresholds. So some that had 100,000 decided to bump it up to 500. Then now we have states sort of reverting from 500 to 100, dropping transaction counts. Kind of at the beginning, and I know Washington was probably, I believe, the first state that started dropping that criteria. And, we're going to see a lot more states doing that and maybe focusing more on just the revenue side. But that's kind of the thing that we're seeing, a lot of changes, just nothing really sort of stays the same. And 3 states that don't necessarily have a Wayfair economic nexus are Florida, Missouri, and Kansas is questionable. And the reason I say that is technically they tried to impose it with not even an economic nexus threshold, like 0. It literally goes, you have one sale into Kansas, you have to collect. And their own attorney general, try to kind of shoot it down and said they don't have the authority to do that. So there's been a lot of conflict sort of within Kansas about it. So usually tax practitioners in general recommend not to file there, just for economic purpose reasons, solely based on that. 2 years in, we do think that at the beginning there probably was some kind of and I don't want to, some tax practitioner call it like a honeymoon period. You do probably get a little bit of time where, companies there would be allowed to get into compliance. Maybe the states, we're not going to be as aggressive, allowing, however it took, whatever months it took to sort of get the software. There were a lot of software vendors that were very overwhelmed at the beginning of this to implement a lot of this. And what we're starting to see that now, I think most states expect that, within 30 or 90 days of reaching the thresholds, you're supposed to be in compliance. I mean, obviously, the other thing is it still applies, Wayfair applies to, everyone, manufacturers and distributors and foreign companies. I mean, pretty much, anyone that makes sales into a state and crosses that threshold. I think the other thing that we are seeing, states still have the physical presence component. So they didn't eliminate that. And that's very important because they look at physical presence first and then economic nexus. There's a few states in the US that are home rule states, and probably some of the most kind of common ones that we see is Louisiana, Colorado. But Louisiana just revamped their system in terms of, how they're going to do the remote seller filing and the sales tax rates. And until July 1st, they had this voluntary compliance, and they had like a one uniform rate for the state of Louisiana. And they had kind of internal fights about it between the parishes and the Department of Revenue. So now from July 1st, what they did is they created this special commission for remote sellers. Now, there's a kind of, that commission serves as the central single agency, and they would collect sales tax, but not on a flat rate, but basically the state and the parish rate is just not going to be reported to different jurisdictions, like the parishes separately and the state separately. But this commission would collect all the revenue and then disperse it to all the parties. I personally think that probably Colorado would be great if they kind of go into something very similar, because I think almost 100 home rule jurisdictions between the cities, the towns, and the counties in Colorado. So it will be kind of great if they adopt something similar. But I think this, as far as Wayfair, I think this is what we're going to see, just kind of on the local and home rule states, how they adopt it for the home rule jurisdictions on a kind of county city level. Actually, there's another thing that came out of Wayfair. I don't want to call it Nexus necessarily, but it's the marketplace facilitator rules. I know some people call it like marketplace Nexus, but what it really kind of started, around the time of Wayfair, and it was when the states kind of realized that they could go after individual sellers or remote sellers, but that does take a lot of effort, and it could be, hundreds of thousands of sellers on a marketplace. Well, how about they just create a law that would require the marketplace to collect, on behalf of all remote sellers on their platform, and the marketplace will be responsible for collecting the tax, remitting it to the state. The responsibility shifts from the sellers to the marketplace. This is still relatively new. There's a lot of confusion about it. The definitions in each state are very different. Some states is more broad, some is kind of a little more narrow. But I mean, it basically comes down to, if you have a business, like the facilitator is like where the marketplace provides a platform that contracts with third parties to sell goods or services, and they facilitate retail sales. In some states, the definition also it kind of includes payment processing or different types of assistance with the sale. And now this was really originally thought out great in the sense that, okay, if it's like through Amazon platform or things kind of more traditional selling tangible property. But what we have seen, some of the unintended consequences of it, and a TBD type of topic here, but what it ended up happening is that companies like, let's say, I'm just going to say like Uber Eats, originally Uber Eats was just supposed to be, the delivery. It's the delivery app or interface between the restaurant and the consumer. Well, in many of these states, based on the definition of that marketplace facilitator rules, they now turned Uber Eats into basically responsible for collecting sales and use tax on the food. Now, instead of the restaurant doing that, now it's Uber Eats' responsibility. Obviously, that creates issues because in some of these platforms, that's what happens to other taxes, like the sales and use tax. Okay, on one side, great, but what about food and beverage? There's a lot of these things that kind of happen from this marketplace facilitator. It's just very confusing. I think the reporting portion of it, if companies sell through their website and then other sources, and then it's very common that now also they'll sell through a marketplace. How do these sales get reported? Is the marketplace collecting sales tax? They technically have obligation to collect in most states currently. They kind of rolled in. But I think out of Wayfair, this area, in terms of marketplace facilitators and how to report the tax and how a remote seller would report it. The other question that we always get is, well, the Wayfair thresholds are on, gross revenue, but does that also include sales through the marketplace, or that's kind of a separate thing? And the answer is yes. Any revenue that comes from that state, so any goods that are shipped into the state, whether it's from, their own website or the marketplace, or just, somebody called in and decided to, order on the phone, it really doesn't make a difference. But in terms of compliance, it kind of complicates things a little bit. So I think that's about kind of the newest thing that we see, from Wayfair. I think the other part that we're going to start seeing is audits. We are 2 years in. We've seen some partial periods, audits where we're a little bit post, pre-Wayfair, post-Wayfair. Over the next year or so, we're just going to see, just the Wayfair period. So we'll know a little more how aggressive the states are. Would they enforce transaction thresholds? How agreeable they may be in terms of delayed compliance, kind of, as well as in, pandemic time, if a company reaches the threshold, they reached it in April or something, or, March. Technically, most states would say, okay, now within 30 to 90 days, you're supposed to register and collect sales tax. But we have seen delays in registrations, from the state side. There's delays in software implementation. So we don't necessarily know whether the states would sort of allow some type of grace period because of the pandemic, but I think it's definitely not out of the question. Yeah, I think that's kind of, in general, what I would say. Over the last couple of years, it's been challenging and it's ever changing. And we've done these nexus reviews or evaluations for clients, and sometimes we have to do it 3 times a year, basically, to redo the thing that we did 6 months ago, just because there have been some changes. So it is constantly developing. And especially on the marketplace side, what I also want to say, we have clients within BKD that are traditionally consider themselves as software as a service providers, or kind of on the technology side. And what's a little bit surprising in some states, that they could be looked at or viewed as a marketplace. So that is something to kind of watch out, is that even maybe a SaaS provider that's has created this platform and is really considers themselves as, we are just providing subscriptions to this platform where buyers and sellers could meet. The eyes of a few states, they could be looked at as that marketplace who is now responsible for sales tax for all of the sales that are happening on their platform.
I appreciate that, John. I mean, because there is just so much to think about and how that's shifted, and even the recent events have impacted that. Anything from your perspective, Mary?
Yeah, well, first of all, I would just say, what's kind of interesting, and I think Jana would probably agree, is the one thing that I think most people can say right now during the pandemic is we've all been buying products off the internet a lot more than what we probably even traditionally have, right? Because we haven't been going out as much. We're trying to stay home, and I can tell you, for example, that I've used Amazon a lot more in the last 4 months than what I normally have. So It would be interesting, Jana, to hear your thoughts on, when we come out of the pandemic, the one sector that really has, I'm going to say, probably done good business during the pandemic are like those online retailers that were, I'm going to say, initially sort of the target of the Wayfair decision and have been complying since that came out. It will be interesting to see whether they are targeted in terms of audits after the pandemic. Because if you were looking, I think if you were a state and local tax department and you were looking for an industry where there was an opportunity to generate revenue, that might be a sector to look at.
A good point to make is that even though there's marketplace facilitator laws, it's important to know that if a company is selling through a marketplace, that they're actually collecting or they have to collect, because even in some states, there's still thresholds. So if it's a smaller platform, they may or may not be collecting sales tax because they may or may not have to, or they might not even know that they're obligated. So that's also something to watch out for, not to kind of assume that, hey, if I'm only selling through a marketplace, I don't have to do anything sales tax wise. I've heard that kind of question before. There's like no consequence, right? And I was like, not exactly.
And I was thinking that, if I get the It Depends podcast, maybe Jana needs to have the sales tax, Is It Way Fair podcast, or sales tax, It's Not Way Fair podcast. I don't know.
Well, Mary, you're on a roll with these creative names today.
I promise everybody that's listening, I'm not going to quit my job to become a comedian, but I have to throw it out there.
Hey, there's always a good tax joke in there somewhere. I'm pretty sure, right?
There has to be. I'm sure that there are going to be several accountants laughing at that. Anybody who's not an accountant is probably like, okay, people, pack it up and go home now. But probably what's important to know is that there have been some states, not maybe as many as I thought, that would have come out with some guidance by now, but obviously with the pandemic and some other things going on right now, I think that's sort of taken a little bit of a back seat. But I would say that there have been a handful of states that didn't already have factor-based nexus standards, that post Wayfair certainly have implemented some factor-based nexus standards, with Wayfair kind of being the jumping off point for doing that, what they considered sort of validation of economic nexus. And I'll throw out a few examples. Massachusetts, they went ahead and introduced an economic nexus standard of $500,000 in their regulation. Pennsylvania introduced an economic nexus standard of $500,000 in their regulation. Texas, for franchise tax purposes, introduced again via their regulations a $500,000 economic nexus standard. So traditionally, for the income tax, it has been higher than what it's been for sales tax. But there are a couple of outliers. Hawaii is using basically the sales tax nexus standard, the $100,000 threshold. I know that like Philadelphia and Pennsylvania, they have their business income and receipts tax. They're using the $100,000 standard for that. And then Jada, you mentioned the Washington and sales tax, and them actually adopting the economic nexus threshold, and then being one of the first states to sort of repeal the transaction piece. They actually also adopted the $100,000 threshold for their economic nexus for the business and occupation tax, which is a gross receipts based tax that they imposed. So there are some states that have done something a little less than the $500,000, but for state income and franchise tax purposes, we actually, we had this concept of economic nexus truly even before Wayfair. There was a lot of dispute about it, about whether, it was truly you could have substantial nexus without having a physical presence in the state, whether that would truly create nexus in a state. And I would say that post Wayfair, I think we'll continue to see, even if it's not the factor based nexus standards, which frankly, I think if you're going to adopt an economic nexus standard at a Department of Revenue, if that's how you're going to implement your state nexus laws, then I think that it really does help taxpayers to actually implement a threshold that is somewhat, I'm not going to say easy to follow, because there are states that say, well, it's not bright line. If you're doing something that's a little less than that, then maybe it still creates nexus. California sort of implements their long existing factor based nexus standard in that way, that it's not exactly a bright line threshold, but hey, you know that when you get above it, you know you have an issue. But I think that it's still very helpful if you're going to impose an economic nexus to have a policy that taxpayers can understand and try their best to comply with, versus what I fear in some cases ultimately will be departments of revenue that say and see Wayfair more as a validation of their existing imposition of nexus based on economic nexus standards. And instead of putting out that threshold, all you can really do is know that, okay, well, if I am entering into transactions in this state with customers, potentially I have nexus, but I don't know if I have nexus when it is $50,000 of sales, or when it's $100,000 of sales, or when it's $500,000 of sales, because there's no guidance that helped me implement that economic nexus standard. But I know that that is how the department, they're going to look at, me actively entering into transactions as creating that nexus. I think it's a little bit difficult when you don't have some sort of guidance that's out there about what does create that nexus. But then again, we've had that uncertainty for a long, long, long time in state and local tax. So we've adapted to it to some extent. I think Wayfair just sort of creates a little bit more uncertainty if there those policies and those regulations thresholds don't exist. So it'll be interesting to see what ultimately happens in some additional states. But for right now, there are some states that have added it, and you just need to kind of be aware that that certainly is an evaluation that you need to do based on your activities with a state and local tax advisor.
For sure, and maybe kind of a related topic to it, because I know, and Mary, I know you do as well as you, Jana, the consultant that maybe comes along with mergers and acquisitions, and doing due diligence on deals and things like that. And obviously, this is something that's become a particularly hot topic because of the potential exposure that might be there, and so forth. Anything that you would maybe add along those lines, or maybe the that lens as to how all this may impact even deals and going through that process?
And we see it a lot in, any type of, transactions, mergers, acquisitions, and things like that. Generally now it's a part of the questionnaires that you get, and the analysis of, it literally is like, have you done a Wayfair analysis? We also see companies that maybe were on the fence and maybe didn't do an analysis or something. They're considering selling, and that's kind of, one of the incentives for them is, okay, we want to make sure that, 6 months down the line or whatever year down the line, we don't have any holes and anything like that. And that's usually a good time to just do that overall nexus analysis and at least look at it from an economic nexus perspective. So that, because it is pretty easy to catch. Nowadays all you need is just the volume of sales and sales by state, and that's about it. So it is something that, in due diligence, it gets discovered pretty quickly. So it's, financing, as well as sort of, kind of any type of transaction that the company may go through. Wayfair does come up, and to prepare for a transaction, that's usually a good thing to do. I would say, even if it's a few months before, there's still an option to, go through it, do the analysis, do possible, voluntary disclosure, and, kind of have a much cleaner process, you know, during the diligence and the transaction itself.
To add to what Jana, Jana mentioned voluntary disclosure. I think that the key to that, Damien, is that there are options for mitigating the sales tax exposure that you have if you get in front of it. And that doing that analysis, someone like Jana can look at that and tell you what those options are for mitigation. And hopefully, in that situation, then you can avoid getting into a deal finding that there's a $500,000 or $1 million exposure and that somebody wants to adjust the purchase price or create an escrow for that. And I will tell you, just because I know this from experience, when you're going through that due diligence process, you're looking at what is the worst case scenario as someone that has to review the issue from the buy side. So oftentimes, what we can do in mitigating strategies like voluntary disclosure is hopefully find something that is less than what the buy side due diligence team is going to come to when they're doing their due diligence review.
So I guess, yeah, we've covered a lot of ground from, telecommuting and, COVID response and legislatively on the federal side, and obviously Wayfair and kind of the update there. Maybe some closing thoughts from you. Maybe we'll start with you, Jana, and kind of pulling things full circle. Anything that you'd like to leave listeners with?
Probably the most important thing is just to kind of know that everything unfortunately depends and it's changing all the time. So, as you guys are listening to this podcast, we kind of share the information as we have it now, but I do expect that things would change, and because they're constantly changing in the next few months, we may see the rest of the states sort of imposing economic nexus. We're definitely going to see changes on the marketplace facilitator rules. So it is something that's, these topics are continuously developing. So I would like to make sure that no one is sort of looking at, deliverables or materials that were from, 6 months ago or a year ago, or even sometimes, I personally have to look it up every time, sometimes when I answer a client question, just because of the constantly changing environment. So that will be my advice is, as you guys are thinking through any of these issues, if there's any questions, definitely reach out to your tax professionals, tax advisors, or anybody on kind of our team, and we could direct you to the best contact. But just kind of not to rely maybe on information that potentially was published a while ago, because it is very likely it's possibly outdated.
It's great advice, and that's a big concern right now with all this. Is the speed of everything has just been so rapid, so fast. Yeah, you really have to start with the date. That's fantastic advice. So, Mary, what about on your end?
One thing I'd like to really emphasize, Damien, and what we try to do for our clients, for our prospects, for our staff internally in the firm that work on taxes and audit, is provide resources like BKD Thoughtware, BKD webinars, and we have a full team of people that have been committed over the course of the last 4 months to trying to put out information in as real time as possible regarding various topics, whether it's a state and local topic and it's about conformity to the CARES Act and talking about NOLs and the carrybacks that might be available, or it's a federal tax issue talking about the PPP loans. And if you go to our website, it's all out there for your free and mass consumption. So take advantage of it, read through it. If you're with BKD, contact your BKD team member to get connected with the right resources. If you're not with BKD, hey, that's fine, but use that to help yourself. Go talk to your trusted advisors. If you feel like they're not doing the job, come talk to us about it. And, if you're someone even internal in the firm, all the people that are here that can help you. Reach out. We're here. We're happy to help. And, we all have a job to play in getting through the pandemic and getting through all of these issues and consequences of the pandemic. So if we work together as a team, we'll all come out stronger in the end.
I like it. Great note to land on, I think, is it does take a team of advisors and trusted advisors to work through it all. So, well, thank you both. I appreciate the time. I know it's been a busy time, and there's always something going on in the salt world. So I'm sure we'll be speaking again in the near future. But until then, yeah, thank you.
Thanks, Damien. We appreciate it. And, maybe next time you can be on our It Depends podcast.
I look forward to it. Yeah, but only if I can also have a guest appearance on This Is Not Wayfair.
Absolutely. Package deal.
Get you on bowl.
It probably depends on your sense of humor, but you might be feeling like it's way not fair that this episode has come to an end already. But Mary and Jana would be happy to keep the conversation going, and you can find their contact info and get additional resources in the show notes of this episode, which are available at bkd.com/simplytax. Now, I would really enjoy hearing from you and getting your feedback, and really appreciate it if you'd let us know what you think of the podcast by dropping us an email at simplytax@bkd.com, leaving us a rating and review on Apple Podcasts, or connecting with me on social media. You can find me out on Twitter, where I tweet about tax at Damien Martin CPA, on Instagram, where I post about my life at the intersection of tax and being a dad at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.